Good morning and welcome to this Wednesday, August 23rd, 2023 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes as we try to figure all this stuff out as the market open draws to a near. Well, yesterday we're going to go over some of the details of what happened yesterday, but we just seem to be hovering. Staying above some key support on the long-term weekly charts, but struggling still to try to really get anything going to the upside. Later today, we're going to have NVIDIA's earnings. That is going to be a very interesting report. I'm going to talk a little bit about NVIDIA, talk a little bit about the semiconductor chart, and it's kind of a mixed picture. NVIDIA is a leader in the semiconductors. I don't think too many folks would disagree with that, but whether or not they're going to come through with earnings this quarter, I don't know. Things don't look quite as good as they did last quarter, but we'll certainly be talking about that later in the day. I do want to welcome all of you, especially those of you who have joined us from our live stream on YouTube. Really appreciate all the new folks that have been following us here over the last couple of months. And we really look forward to providing more and more solid education regarding the market. Hopefully you enjoy this, and hopefully over the long term it helps in your trading or investing. I'm going to go ahead and jump in. Oh, and one other thing. After this show today, we do our live trading. That begins at 10 a.m. We have a live trading room. It is open only to our members. So if you're a non-member, it'd be a great time to take out a 30-day free trial. That 30-day free trial, among a lot of other things, will get you into our next 5 Wednesday live trading sessions, including this morning's. So I want to make sure everybody's aware of that. You can go over to earningsbeats.com and hit the free 30-day trial button, and we'll make sure we get you all set up. Okay, let's go ahead and jump into the action from Tuesday. And you will see that the Dow Jones Industrial Average was down 175 points. S&P 500 down 12. NASDAQ 100 down almost 28. Mid caps down 13. Small caps down about a half of 1 point. And so overall, it was down. I mean, we were down just about everywhere. Really nowhere to turn. You can see transports down almost 0.75%. So it was mostly a down day. There were a couple of reasons for it. We certainly saw retailers getting pounded yesterday. Dick's Sporting Goods had its worst day since its IPO. I think it lost about 26% on the day. So we saw a lot of retailers getting hit. A lot of the clothing and accessory, those companies took it on the chin, and the market really didn't rebound from that. But on a percentage basis, the Dow took the biggest hit, losing just over 0.5%. NASDAQ 100 actually did a little bit better, dropping about 0.2%. That small cap index was down 0.3. And again, as I mentioned, transports down 0.2. As you also see down here below with the sectors, while real estate and utilities, 2 defensive groups, led the action to the upside, rising both of them around 0.3%. One of the big losers was the financials. And it's easy to see why the financials lost. First of all, looking at the chart, all of these charts, you can see none of them very good. We've got real estate downtrending below its 20-day, which is below its 50-day, PPO negative. Utilities downtrending down near the 63 level, which if you look back over the last 6 months, this has been a good support area for utilities. So maybe yesterday's bounce is a little bit intuitive. Maybe we'll see a little bit more of that money rotating into utilities here. Probably is going to take the 10-year Treasury yield to drop, though, to be honest, because this latest move in the 10-year Treasury yield to the upside has been triggering some of the selling, maybe most of the selling in the utilities group. But nonetheless, we are at the 63 support level. We'll see if we can bounce there. Price action below the 20, below the 50, PPO negative. And then there's the financials. Financials, which had bounced off of those March lows. If you recall, we had a really bad March. A lot of the regional banks taking a big hit with a lot of deposits leaving many of those banks. Well, we've had a really nice run from that March low all the way through the end of July. And that was part of the reason why the market did so well through the middle part of July, as we had banks recovering. Well, the last 3 or 4 weeks, not so much. Banks have rolled back over again. Yesterday, dropping almost 1%, down below the 50-day. The 20 is still above the 50, but unless we have a quick recovery, we're probably going to see that death cross right there. PPO just now moving into negative territory. Overall, AD line looks pretty decent on the financials, though. So maybe this is a sign that we can expect a reversal. We did have a couple of tops on the XLF between 33 and 34. That was back in April and then again in June. We broke out through that, and now we're back down between 33 and 34. So maybe that's the support level, and perhaps we'll get a bounce. But technically, looking at the action below the 50-day and pointing lower, PPO turning down, you really want to see the market prove it to you from a long perspective here in the financial area. From an industry group standpoint, hotels actually had a pretty good day yesterday. There weren't too many areas that were strong. Hotels up more than 1.2%, gaining 35 points. And it has been in a pretty steady uptrend. That AD line also has been trending pretty well to the upside. But then there's the banking group. And here is where you can see the banks, very similar to the XLF, and the XLF, moving back down. The XLF, of course, was hit by the banks back in March. You can see right there, the bank's big drop. XLF goes with it. Well, look at what the banks are doing right now. It's not unreasonable to assume that financials are going to get hit with banks when they go down like this. So can the banks hold on to some recent support? Their high from April and June that was cleared around the 425 level did not hold. So the financials, which are trying to hold that 33 to 34 area, are not really getting support from the banks at this point in time. Another group within the financials not performing well, investment services. You can see the banks dropped almost 2.5% yesterday. Investment services down 1.7%. They too lost the 50-day moving average, and seems like death crosses are probably coming to both of those groups. And the AD lines for both banks and investment services, not too bad. We have been moving lower, but I would say overall the uptrend remains in play. So we got a little bit of a mixed picture, and I'll be honest, I think there's a mixed picture everywhere in the market. I think this is probably the most difficult period so far in 2023 from where I'm looking. Things that I look at, I see a lot of mixed signals. Started last month, middle part of July. There were a number of negative divergences all over the charts. We had a lot of optimism in the options world, a lot of complacency in that 5-day moving average of the equity-only put-call ratio. The VIX and the S&P 500 had moved to the upside together, creating a slightly positive correlation. That almost always signals a reversal. So we talked about that about 3, 4, well, maybe 5 weeks ago, mid-July, and a lot of that is playing out. So the question is, do our technical areas of support hold? Short term, they haven't. Longer term, it remains to be seen. We're certainly getting close to that level. And we got 2 big events coming up this week that I would pay particular attention to. The first will be NVIDIA's earnings after the close today. And I'm going to talk about that chart in just a minute, so I won't say anything else here. And then Friday, we've got the Jackson Hole speech by Fed Chief Powell. And it doesn't take a whole lot of memory to remember what happened last year when Fed Chief Powell gave his Jackson Hole speech, August 25th, 2022. That was the day he said more pain ahead for stocks. And the market, I'm not so sure they moved down because they felt like there was more pain. I think it moved down because I think the market lost some confidence in the Fed. Fed has no business talking about which way they think the market's going to go. I think that's the wrong approach for the Fed. I think they need to stick to their mandates and leave the stock market to Wall Street and to all the traders. But that's just my opinion. Didn't work out so well for Greenspan back in 1996. Remember, he talked about irrational exuberance. Market was up too much. 1996, thought this was just crazy. Market had one of its biggest runs over the next 4 years, biggest runs in history. These Fed chiefs are not Wall Street analysts. They don't study the market. They probably don't know what a candlestick is other than the one that might be sitting in their dining room. So I wouldn't pay any attention to what the Fed has to say in terms of their market predictions. But what they say about what they're going to do with interest rates, that's a different ballgame. And so that we'll hear from Fed Chief Powell on Friday. And just based on history, I don't trust him. I don't trust the Fed. And so I think you probably want to be a little more cautious ahead of this Friday meeting. And let's just see how the market reacts. If we get one of these big red candles where we break down through some key support, I would be out of the market. If you want to short, you can short, but that's not really my style. I have to kind of evaluate many other signals. But I'd be a little careful if we have a big selling event on Friday after the speech. Anyway, let's keep moving. Got some stuff to go over. 10-year Treasury yield. We do have new home sales coming out later this morning. The expectation there is to actually come in at 705,000 units, and that's for the month of July. June saw 697,000 units. So we're actually expecting about a 1% increase from June to July. We'll see if that happens. Some of the news coming out of the home building area has not been good. Of course, mortgage rates are the highest we've seen in many years. And we're seeing a slowdown in some of the numbers, some of the reports that are coming out. So new home sales, are we going to hit that 705,000 number? I don't know. Probably for the Fed, we probably want to miss. We probably want to miss a lot of these economic reports to keep the Fed from remaining too aggressive in terms of hiking interest rates. But anyway, that's the big news for later today, 10 a.m. this morning Eastern. New home sales will be out, so you might want to check that out. And also check out what happens to the market after 10 a.m. and potentially what happens in the bond market. So here is the bond market, 10-year Treasury yield. And you can see we are down to 4.26%. There is our double top that you can see. If you can't see, I'll make it a little easier. So there was your 433 top back in October of 2022. At that point, 10-year Treasury yield actually had a negative divergence, and we ended up falling back. This time, we're testing that overhead yield resistance at about 433, went a little bit above it. I think on Tuesday, we got up to about 436, I believe, maybe 437 intraday, but then came back down, closed at 433. And now here we are at 426 and change. But look at the PPO this time. Again, last time in October, when we made this move, had a reversing candle, had a negative divergence. This time, we actually have the PPO continuing to rise. That's suggesting that this potentially has, more room to run to the upside, but we do need to get a definitive breakout. We've been challenging that 433 level, closing just above it back on Monday, but I wouldn't exactly say that this was a massive breakout. So we're pulling back from this overhead resistance, yield resistance. Question is, do we hold 420? That's the key. That's the first key area of yield support. And then you've got the rising 20-day moving average, which is currently at 415. So I think your support is between 415 and 420. And I believe what the Fed has to say on Friday may have a lot to do with whether or not we break out to the upside or whether we fall back even further to the downside. One thing that does look interesting, normally when we get the yields rising, we tend to see financials outperforming the S&P 500. Back last year, when we were rising, you can see clearly we were moving up in the relative strength of financials was moving higher. Then we turned lower. We came back down. We had a little pop. There went the XLF leading again. Down and up, down and up, down, down. Sideways, maybe with a little bit of downward bias, and then we kept going down. But notice since we've been rising over these last 4 months, banks not really, or financials not really performing well. A lot of that has to do with banks. And I think some of that is the inverted yield curve. Banks typically do not perform well with an inverted yield curve. I audited banks when I was in public accounting, and I can tell you that when you start seeing the short-term treasuries moving above, the yields moving above the long-term treasuries, it squeezes profit margins in a lot of banks. And as a result, they're not going to perform as well. I would not expect leadership in that particular environment. And it remains to be seen whether or not that inverted yield curve impacts bank lending. One thing impacting some of the lending is the mortgage rates, because mortgage rates are so high, you're not seeing a whole lot of as much lending in that area. Anyhow, I found that kind of interesting. Also, as we break out, normally we have that same relationship with industrials. When we see the yields going up, typically when the yields go up, they go up because the economy is strengthening. That's normally why yields go up. And if the economy is strengthening, that's a great thing for transportation stocks and for other areas of the industrials. It's also a pretty good thing for banks. I mean, if the economy is getting stronger, that means fewer loan write-offs. They're willing to take, banks generally are willing to take more risks, especially if the rates are going up, 10 years going up, and the say the 3-month or the 1-month treasury yield is going down or staying flat, because then you have the opposite of the inverted yield curve. You start to see that yield curve expand to the upside. And as that happens, banks make more money and they lend more. So those are some of the things to think about. But right now the yield's going up and these two aren't going up. And so again, so many things are mixed in the market right now. But I think this is telling me that, you know, as the Fed keeps talking about fighting inflation, I think part of this is still maybe the 10-year, you know, investors, bond investors requiring a higher yield to cover potential inflation. But when I look at the XLF and the XLI, I don't see a massive, you know, growth period ahead in terms of our economy. And it seems like that's what the Fed's trying to fight. So again, we're seeing all these mixed signals, and I'm just going to let it play out and try to follow some of my signals. But in the meantime, just understand there's a lot of uncertainty right now in the market. S&P 500, moving on to the charts. So this is where I think things get very interesting, because on a daily chart, if we go all the way back to that August high right there, actually the August high was at about 4,300. You can't see it. There was August 25th last year, by the way, right here. That was Fed Chief Powell's speech. So if you're wondering why we ended up going back down for 2 months and setting a new low, in my opinion, this was the primary culprit. It was the speech of Powell back on August 25th, 2022, talking about more pain ahead. Anyway, I'm not going to talk about that anymore. But earlier in August, we had set the high at 43.05. That was the highest close on the S&P 500. And when we broke above it in June, you can see we have not gone back down below that 43.05 level. We've gotten close twice, moving below 43.50. We've not gotten below 4,300. That's going to be a really important support level. And if we look at the weekly chart, you can see there was the high from back in August. This was lower low, lower high, lower low, lower high, lower low. And as long as that lower high held as resistance, we were in a downtrend, more of an intermediate term downtrend, potentially long-term downtrend. But instead, we came back up, and it was in June when we took out that 4,300 level. So as we're moving back down, this was a very, very big resistance level back in from August of 2022 that we eventually cleared. And now as we come back down, that's going to become a very big support level, along with the rising 20-week moving average. Again, if you go back during these secular bull market advances, the 20-week moving average served as tremendous support on many occasions. We had a couple moves just below the 20-week, but not by much and not for very long. And we stayed almost entirely above that 20-week moving average. So what I would suggest here's the 20-week moving average, which is at 43.37 right now. And we know we got price support at 43.05. And what I've said as part of this secular bull market theory, which I believe we're in, this is the biggest area of support. This was what I considered the worst case scenario for a secular bull market, was to go back down to this 4,300, 4,340 area. And that's what we've done. That's about where we are right now, 43.87. So we still got a little room to the downside, but I think we need to hold it. If we do go a little bit below the 20-week, I really want to see that 4,300 level hold. If both those levels go, I think personally for me, I'll be in cash. I won't take any chances until the market can establish its move back above the 20-week. Because once it does that, you don't want to miss the potential for the move to the upside. We've seen that multiple times here just over the last 5 years. So respect that 20-week moving average, respect 4,300 support. But if they go, it's a different ball game, at least temporarily. So keep that in mind. The NASDAQ 100 downtrending. We saw that negative divergence, higher prices, lower PPO, and we've been downtrending ever since. Tried to rally the last couple of days, so far failing, just below the 20-day moving average. If you're bearish, that's kind of what you want to see. You want to see failures at the 20-day moving average. I think whether or not we move through the 20-day moving average or roll back over might have a lot to do with NVIDIA's earnings report that comes out after the close today. NVIDIA not only is probably the strongest semiconductor stock in 2023, or certainly one of them, but it's also a big component of the NASDAQ 100, along with all of the semiconductors. There's a lot of representation in the NASDAQ 100 by the semiconductor group. So it's going to be really important to watch this as things unfold. IWM, this one on a daily basis, you can see we're getting a death cross in the short term. I mean, we've seen it before, but it can lead to further weakness. We've got a lot of price support in the 179 to 182 area. We tested 182 on Monday, so far holding. And one thing I'm watching here is we do have higher lows in play for the last 2 days off the low we saw on Friday of last week. So Monday and Tuesday both did print higher lows, but not great. You know, we're looking at the last 6 days. 5 of those days we closed below the open, red filled candles. So I'd like to see a big move to the upside, and one in which we see a lot of intraday buying. To the downside, watch that 182 level. I think if, depending on how much room you want to give, the breakout here was about 179. We got up to 181 change, maybe 182, pulled back, tested this breakout area, and then took off. Since then, we've come down twice and held 180. So I think we're really close to a key support area here on the small caps. Transports trying to hold on to the 50-day. I think this is a really key area of support on the transports as well. So you can see as we go through all these charts, how many are at or very near some critical support levels. I think the biggest one for me is going to be 4,300 on the S&P 500. That is where I'm okay with negative divergences, the historical bearishness that we see in August and September, actually starting in mid-July. I'm okay with the market pulling back. We had the warning signs, talked about the fact that we probably were going to struggle for a period of time. So I'm okay with what's happened, but losing 4,300 would be a big deal. And also, I'm going to show you something on the semiconductors in just a minute. First, if you like the charts of the day that we do on the show, and we send out 3 times a week to our Earnings Beats Digest members and a chart of the day. And if you'd like to subscribe to that, go to earningsbeats.com, over to our website. Both names are plural, earningsbeats.com, and scroll down. You'll see the sign up area for the Earnings Beats Digest, name, email address. Hit that subscribe button. We'd love to have you as part of our community. We do a lot of free events, and when we do, we reach out to this group, provide room instructions. So this would be a great time to join, not only for the 3 times a week chart of the day, but also, we're going into a pretty key time of the year, August, September. We're getting close to some pretty significant support levels. I'm sure we'll be doing some more free events. And so make sure you are part of this community so that you can come join us when we talk about the future of where we think the market's going and so forth. Very important that you're a subscriber there. Okay, so for today's chart of the day, I wanted to show you NVIDIA. And I'm going to go back a little ways. Let's do a couple years here. And you can see that, throughout the cyclical bear market of 2022, all of the semiconductors did not do well. Most of the semiconductors did not do well. And NVIDIA was certainly one of those. We went from 350 down to about 110. Let me say that again, 350 to 110 in less than a year in one of the best companies in the world. Well, that was pretty quick to change. We came back up. Notice we had kind of a neckline right there, left shoulder, right shoulder, and here's your head. We went up in January and we broke that neckline and we never looked back. Huge move to the upside. Well, I want to point out something right now, and that is that there is a potential neckline here, although normally you don't want to see the right shoulder go up to where the head was. So I'm not so sure this hasn't been negated, but it's still a pretty significant support level, whether you want to call it a topping head and shoulders or not. This is kind of a big deal. The other thing is yesterday we had a reversal on heavy volume. And if you notice down here, volume has been kind of heavy on some of these down days. See these couple of red candles in July coming down? Right here was a big reversal, heavy volume. Another one of these days that were down, heavy volume. Volume trends have started to turn at least to neutral and maybe even a little bit bearish. While NVIDIA is up here potentially putting in a double top. Now, you don't confirm the double top until you get this breakdown below 400. But I'm just throwing it out there. The other thing is, notice when we went into the last earnings report for NVIDIA, see this move to the upside? Look at the relative strength moving up. Also, I wanted to show the AD line on here. So let's come out of here. We'll just go down here and add it. Actually, scooter line, let's just change this back to the AD. So here's your AD line. Look at it going down. Just recently, just within the last week, the AD line was the lowest it's been in about 3.5 to 4 months. If you look at the AD line when we were going into this last report, AD line was going straight up. So that kind of gives me a little reason to pause here a little bit. We got a double top. NVIDIA continues to perform well relative to the S&P, relative to its peers. It's doing some pretty good things, but that AD line's a little worrisome. Double top, volume trends. I don't think this one is a slam dunk for a positive reaction to earnings. And, there's been so much hype in NVIDIA over AI. Anything that they say negative could impact the company. I'm just not quite so sure here. I'd be careful. We got 1 minute to the market open. I want to show you 2 more charts real quick. One is the semiconductor chart, which does, in my opinion, show a pretty nasty looking head and shoulder top. Doesn't confirm until we actually get the breakdown though. But here is your neckline. Here's your left shoulder. Here's the head. Here's the right shoulder. Almost perfectly symmetrical. And then you've got this neckline down at 92.50. Now, if this breaks below 92.50, we're looking at probably at least 1,000 points. Maybe, I don't know, maybe a little bit less or maybe a little bit more. But that could take us down into this gap support zone on a measurement basis. So semiconductors have me a little bit nervous here, and they're going to depend on NVIDIA. If NVIDIA's report is not well received after the close today, we could see semiconductors move back down to test this support level. And if that fails, that's going to put the S&P 500, 4,300 in jeopardy. So NVIDIA may have more control over the market than you might think, and it certainly might go beyond just the semiconductor group. And then, of course, the Fed on Friday, which, who knows? I mean, I don't even want to make a guess as to what is going to be said on Friday. I know from a year ago or a year and a half ago, we've seen the core CPI rate drop, the annual rate drop from about 6.5% to 4.7%. When the Fed first started talking about inflation, they just wanted to see it start to get into check, and roll over a little bit. I mean, I would say at this point, 18 months in or whatever, and seeing it go from 6.5% to 4.7%, pretty good move in the direction they want. But they continue to change their verbiage and what they want to see and what needs to happen. And I really think they're just concerned that the unemployment rate has remained low. The overall economy has been fairly resilient, especially in housing, given what we've seen. And I think they just, I think if they had it their way, they'd like to see the market drop. And so that concerns me with what might be said on Friday. Anyway, those are the two big events. Last chart I want to show you is the retailers, which have just been getting hammered. Yesterday, I talked about Dick's. Macy's doubled their expectations on earnings. They maintained conservative guidance. And I want to show you the chart on Macy's. Yesterday, breaking down to a 52-week low, losing, I don't know, what is that, 20%, maybe more, I don't know. And then today, already down another 2%. How about Dick's yesterday, moving down, having its biggest down day since its IPO, losing 26%. Look at it again today. Now let's go back and look at that XRT, and you'll see the whole group is rolling over and moving down. And this is a pretty good area of support. I'm going to say 61 to 62 needs to hold the XRT. The other thing I'll mention, last thing, and then we're going to wrap this up. The XRT, if you look at this 5-year chart, just glance at it real quick, flat, down, big move, and then down and now sideways. I want you to look at the IWM, small caps. I mean, I see almost the exact same chart. Sideways down, big rally, back down, sideways action. Let me pull up that XRT again. Look at this. Now, retail isn't necessarily a big part of the IWM, but they sure do trade very similarly. And so this is a little unnerving for me, seeing the XRT trading the way it is right now. With that, I'm going to go ahead and close this thing. Let's see if we're still in positive territory. We are. NASDAQ, S&P, up about 0.3, 0.4%. Small caps have moved down. They were up in pre-market. I don't know. We'll see what happens with NVIDIA today and with the Fed on Friday. As you can see, I'm not overly excited about this market right now. I've got too many mixed signals. I will say that the biggest signal for me, though, the biggest thing is holding 4,300 support on the S&P 500. So watch that. All right. In about 35 minutes, we'll be starting our live trading show or live trading class. If you want to join, if you go over to Earnings Beats right here, start your no-cost trial. We'll get you set up, and you can join us in about 25 minutes. And I'll talk a little bit about how I would approach this market today. That's it. Everybody have a great day. Happy trading. Hopefully see you in about 25 minutes. Take care.